Well, you know, David's been talking a lot about this issue as of late as well, and that's all of the states and governments that are selling off things like their roads. Companies like Australia's Macquarie Bank and Goldman Sachs are paving the way for investments in public infrastructure broadly, a veritable road to riches for some. But if all the smart kids jump into bridge buying, does that mean you should too? And in fact, how can you? Well, joining us on set today, Michael Sonnenfeld, founder of Tiger 21, peer-to-peer learning group for high net worth investors. And Michael, just a quick recap for people, because you told Mark and I last time, you know, how many people, the average net worth was what, $10 million of you and your peers?
We have 130 members in about 8 locations around the country, and we're managing a little under $10 billion. That's our individual members collectively managing that amount of their own money.
All right, so this is a lot of money, and right now, you and your group, you're talking a lot about this infrastructure.
We
you
are.
hear about Goldman Sachs and Macquarie coming in and, you know, maybe buying the toll road or the rights to toll road in Indiana or Pennsylvania or whatever it might be.
But
there's a way for individuals
plants
to get in there? Okay.
Sure. There are ways for individuals. First of all, our members are looking at different plays. You can do it in stock plays. You can do it at the companies like the engineering firms, Jacobs, Foster, Wheeler. We're not investment advisors, but, you know, people have stock pickers. The big thing happening lately is the private infrastructure funds. This year they're going to raise about $30 billion. That number's been doubling each year over the last 4 years. But with the private infrastructure funds, those are what are called long-dated assets. The beauty for a pension fund is they can lock in a 30-year inflation-adjusted return. And that is such a big advantage that it may be a better play for an institution than an individual.
So it's not necessarily a good thing to go into Goldman Sachs, if you can even get into their infrastructure fund. There's a lot of potential buyers out there for these properties.
Sure.
I mean, I know many people would say, oh, the states are probably making a big mistake. They're desperate for the cash. It's going to not work out well. But, you know, you look at the Pennsylvania Turnpike, there's an awful lot of people who showed up at that auction. You might imagine that they may end up overpaying.
Right. Well, we're at historic credit spread lows, credit narrow, and with low interest rates and low spreads, there's plenty of liquidity around. So that's a factor. The bigger risk, although overpaying is always a risk, the bigger risk is when you buy one of these assets, if you finance it short term, you have a refinancing risk 3 to 5 years out. And if interest rates have moved, you can wipe out the whole equity. So one of the really important things to make sure is that wherever you're investing, that the underlying finance matches the dating of the asset.
Right.
Let me ask you about another risk, Michael. Let's say you buy the New Jersey Turnpike, and let's say 5, 7 years from now, one of your costs goes sky high. So you want to raise the tolls. Now, even though the state doesn't own the Turnpike anymore, there's going to be intense political pressure to not raise the tolls and squeeze your margin, isn't there?
There will be. I'm not an expert in turnpikes, but I think there's a big difference.
My point is, any publicly used asset is going to be subject to pressure from politicians, whether it's privatized or not. And if it is privatized, it's the private company's profit margin that is going to be in the vice.
Sure. Mark, the distinction I'm trying to make is some of these assets are like toll roads. There's not a lot of upside, but it is inflation protected.
Right.
But, you know, the London City Airport was just sold, and that's a completely different story because that has like 20 profit centers. And so one of the things that our members are looking for is those particular assets that can have operational transformation. It turns out the London City Airport was bought by your owner, GE, in a partnership, but they're bringing their operational expertise. So the plays we're looking for is not just where you have a long stream of income like a toll road or a water plant, but where you can really make an operational transformation and change the fundamental value of the asset.
Now, there's an Australian company called Macquarie that seems to be figuring in every one of these potential deals. What about just simply buying shares of Macquarie? I have no idea whether that's a good or bad thing.
Well, they also have an ETF, which is an important thing. Depending, you know, you can play these so many different ways that it's investing 101. I think the distinction is just to understand that these assets are, in a certain way, a different class. One of the things that's happening in the private equity world is they can put a lot more leverage, and we know that that has good and bad. In the good times, it's really good, but watch out when the times turn.
All right, well, it's certainly interesting. I mean, that there's a way for individuals to even play on something we hear so much about. Michael, thanks so much for coming in. We all appreciated it.